So let's talk about the program. Why do you call it Market Timer?
Well, I call it Market Timer because it has an uncanny ability to actually time the market. It allows us to look at herd behavior in the market, crowd psychology, and you can actually see on a visual basis the crowd moving from buying postures to a selling posture. And then it also gives us really accurate supply and demand in the market. It allows us to quantify, it allows us to track, and it allows us to measure the actual amount of supply and demand every single day in the market, which helps tremendously when you're trying to time the market. And so Market Timer came out of my frustration of trying to invest in the market, but not get caught in either trying to sell the market when the market was going down, and then the market, of course, would reverse as soon as I started selling, or getting into a situation where the market is already on a rally and then selling at the wrong time because I thought the rally was over when it really isn't.
With all those numbers and all that computation, that probably would seem overwhelming to your regular trader just getting in. How automated is your system to provide that information to your client? Yeah.
So there's three indicators that are part of Market Timer that help really any investor time the market much, much better. Our supply and demand index, the balance of power, and our proprietary volatility index. Between those three, which are very easy to read, and all the tutorials are on our website, almost any investor really can have a much better track record of investing in the market on a short-term basis, really catching those big swings. So if you're looking for a swing of 500 or 1,000 or 1,500 points on the Dow, or even 13,000, like one of the case studies that we have on our website, that's possible with Market Timer. The supply and demand index actually quantifies, measures, and tracks the supply or demand that happened in the market for that particular day. We measure typically the number either positive, which means that there's demand for stocks and people were buying stocks, or a negative number, which means that people were selling stocks, and it shows that there's more supply in the market than demand. And so a typical range of the supply and demand index for Market Timer is between -50 and 50, +50. And typically, we can tell on a day-to-day basis whether there was more selling going on in the market or more buying going on in the market, and sometimes it always doesn't match the price. So for example, yesterday, the market was up 140 points. I should say the Dow was up 140 points. But our index indicated that there was actually selling going on in the market as the market was rising. And our supply and demand index was a -4. Today, when the market opened, it was down 100 points, realizing that, in fact, there was selling going on in the market that would carry over into the next trading day.
Cool.
Now, that's just one way that we measure supply and demand in the market and crowd behavior. The second thing that we use is what we call the balance of power. And this is a visual representation of actual crowd behavior in the market, moving from the buy side to the sell side. The balance of power actually shows you the crowd shifting from a buying posture to a negative posture. And when you see that shift taking place, if you're long the market and you're in a buy, there's more buying than selling, the balance of power is definitely on the buying side. That's the time when you want to get out. So an average trader and investor, we talked about short-term trading before, how dangerous it is, how you can churn your account, how brokers make their commissions based on the number of trades that you make. Well, that's not always in your best interest. Your best interest is to get into a trade in which you have the greatest opportunity to flow with the crowd into either a buying position, which would precede a rally, or a selling position in which there was a decline coming into the market. And most of the time, from our studies of this system, we've seen that the average hold time is anywhere from 2 weeks to 3 months. And the best profits are generally held for more than 20 trading sessions, which is typically about a month long. So you want to be in those big swings. You want to see the market. There's a lot of traders who will play the day trading game, and they'll go in and try to scalp a point or maybe even a half a point or even a quarter of a point here and there. Of course, they're paying commissions on every single trade that they're doing, and their timing has to be absolutely perfect. With Market Timer, you're going to be in a perfect situation where you can get into the market because you see buying coming into the market, you know that prices are going to rise, and you can get in early enough with a small position and then build that position up over time as the market continues to rally. Or on the other side, if it goes down, you can also build up a position so that you take advantage of a decline. So the balance of power is really important. It's one of the components of Market Timer. The supply and demand index is also extremely important. The third component of Market Timer is our proprietary volatility index. So just like the CBOE has the VIX, well, the VIX is a great product, and it shows investor sentiment over time, and it tells you whether or not traders are complacent or they're nervous about the market in general. And when the VIX starts to rise, you can generally, the market also goes down, typically. Not always, but typically. Our proprietary volatility indicator measures actually crowd behavior. So it measures the nervousness of the crowd. If the crowd is really complacent and it's really not, very, very happy with the way, the market is going, either up or down, it will show, and it's actually represented in a number. The range of our proprietary volatility indicator is 50% to 150%. When it's down around 50%, things are usually very calm. You're in a rally. As soon as it starts to rise and it gets above 100%, then it almost always indicates that we're going to go into a bear market stance. So stocks are going to start selling off. And at 100% to 150%, the market almost always, if it stays in that range, declines in a significant way. In August of 2015, it was between 100 and 150%, and the market lost approximately 3,000 points.
Wow. So it works.
It works very well.